Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, today we're going to talk about year-over-year home prices, year-over-year inventory changes, the number of pending sales, very cool data with national data. So this is not Vegas. This is the whole country. Some of this is going to surprise you. This is probably not going to be what you expected.
Okay, so these are all pretty charts. Todd is very excited. If you like charts, if you like data, please subscribe, hit the notification bell. We are marching toward our 1,000th episode. So you want to be notified when our videos come out so you can come along for the ride on our way to our 1,000th episode. We have less than 20 left, so please come along the ride and join the ride. Let's go with our pretty charts.
Okay, so the first one, this is the Zillow Home Value Index. This is March 2023. This is the change in prices year over year. Now, keep this in mind. 2021 to 2022 was literally probably the highest change ever seen in home prices. Substantial changes, right, in a year. And even with that, Miami, 8.32%. March of 2022 to 2023, home prices still went up. Actually, every market you can see on here. And it says down there, United States, 2.98%. So the U.S. as a whole, 3% for the aggregate for the whole U.S., right? You can go down and see the different places where home prices went up for the year. Pretty substantial there. What is then going to be interesting is the bottom. This is the bottom of that list. So we skip everything in the middle. We went right to the bottom. These were the absolute worst markets. So you can see they're mostly in the West Coast. Because remember, this is year over year. And in 2021 to 2, we had the highest change. So while the South and everything was moving along, we were exceeding them. So we have corrected, okay? We have corrected. You don't get 3 years in a row of 20% price appreciations and then, or 15 to 20%, and then you don't have some kind of adjustment. So San Francisco one you could see had the biggest change. It was about minus 9%. San Jose, which is basically the same thing. It's the Bay Area, right? Austin had a change. Seattle, Sacramento. Vegas, minus 3.93%. Year over year, which is pretty, like a year ago, people were talking 40, 50% in Vegas, right?
People are still talking that.
They're still, it's still going to happen. The reasons change. Economically, there's only one thing that affects price. Two curves. Do you know what the two curves are called, Juana?
Supply and demand?
Supply and demand. You have a supply curve and you have a demand curve. And the intersection of supply and demand curve is called price. And you can have disequilibrium and things like that. But effectively, supply and demand determine price, and even with that, nothing else that affects. And you can make arguments for why supply and demand is going to change. But bottom line is, this is pretty benign. If you strip out basically everything below Sacramento and below, everything else, like, yeah, okay, so price is adjusted on the West Coast pretty much. Even San Diego's minus 3.78%. But remember, this is what's interesting. We've been doing our Las Vegas market updates, and we've been looking at San Diego, and these markets are both increasing again. So even though they're down year over year, big deal, they're starting to go back up again.
Well, the other thing to keep in mind is that they are up substantially from 2019, which was the last normal year we had. So even with being down year over year from last year a couple points, when you're looking back to 2019, which was the last normal year, they are still up significantly.
Okay, here's the other thing. This is new listings. That gray area is the pre-pandemic value. It's the average for how many new listings would be on the market in March of whatever year, right? So March 2023, though, is the blue line. You can see, and we actually went through this whole chart. In every single market, there are less homes on the market than there were pre-pandemic. Every single market.
So we've talked about that. A good portion of the reason is because sellers are hanging on to those 2, 3, 4% interest rates, and they're not putting their homes on the market. So because of that, we have a lack of inventory. That, and you combine it with the residuals from the pandemic as far as the supply chain issues, and then you combine it with the low building permits, the low number that builders are building, and all of that results in low inventory levels. So this is really important because it's these low inventory levels that are really the root cause of what's keeping the prices where they are. Now, that doesn't mean that if we have more inventory, prices are going to drop, because every month that we have low inventory, there's more pent-up demand from buyers, because either they haven't found what they want, which is probably most buyers. We've had buyers in town for the last few weeks, and we're going out, we're looking at houses, and guess what? They can't find what they want because there's very little inventory. We had a buyer in a couple weekends ago, and he came in and he was going to spend a ton of money, but in the community that he was interested in, there were only 3 listings, and none of them were what he wanted. We went out with somebody this past weekend. We looked at, again, 3 listings because that's all there was, and none of them were what he wanted. So
a ton of money.
A ton of money.
Yeah.
So this is really important. So we're talking not just in the $400,000, $500,000, $600,000, $700,000 range. We're talking 7 and 8 figures, and they can't find anything. So what's happening is a lot of these people are choosing to build. So that's an interesting thing. So I think that's something you're going to see more of. Obviously, people in under $1 million are not going to be able to go out and build.
Right.
That's highly unlikely with the price of lots. But when you're talking in the luxury market, you're going to see more and more custom homes. I think that's going to be very interesting to look at.
We do, but we have 2 constraints with that, because I do agree. I think that could happen, but there's 2 constraints. One is you just can't. There's not like there's people sitting around twiddling their thumbs. Okay, meaning builders that just can magically turn on resources and build. The other thing is these people that are spending all this money want to move in 30 days. They don't. Some of these these luxury homes, they take a long time. This is not tract home that you can put up in 5 or 6 months. These things take a ton of time.
A couple years.
Okay, we're going to move on. We're going to show, here's more new list. This is more data. Now, those first ones you saw were big cities: New York City, Houston, Dallas, Miami, big metro areas. These are not super big metro areas. Nashville's in here, San Francisco, Las Vegas, San Diego. But you can see, even in all of these markets, a pre-pandemic number of homes that were available. And then the March 2023, see Las Vegas is a substantial difference. Of course, we have a significant shortage of inventory in Las Vegas. And this is the reason why prices are going up in Las Vegas. In the last 3 weeks, we've had prices go up $1 a square foot for 3 weeks straight. And this is close price per square foot. These deals were put under contract 45 days ago. And we know this is going to happen for a couple more months, because this happens every year for a few more months. So year over year, we're going to have some random stuff happen, right?
Absolutely.
Yeah.
To me, it's interesting to just track it both week to week, month to month, and then look back year over year, and then look back what was normal pre-pandemic. I think that's really important to look at that and not just look at 2021, 2022, because those years, they were anomalies. They really don't describe the market in an accurate way.
I'm frankly fed up with the people who are like, but Todd, Redfin says from the peak of the market in June 2022 and the number of sales that month that we only have 43% of the sales that we had that month. Like, good. That is not the benchmark to which we measure everything. Frankly, we have some more slides that are going to solidify that, make this more obvious what's going on. But, waiting for home prices to have gone up 40 to 50% and then picking that peak number, which was a frenzy as people were buying homes, as interest rate where they had basically got a purchase, locked a loan rate. They could see loans were literally going up on a daily basis, if not weekly basis, going up, 0.1% or whatever every week. And they were frantically trying to just lock something in, not really concerned about the price, because they wanted to still get a 4% loan or a loan under 5%. Okay, so if you can forget those home prices, I don't want to hear any more about June of 2022. It doesn't really matter. Okay. Now, with that being said, we have low inventory. So because of low inventory, something Juan has said is we have less homes to pick from. That's why sales are down. So let's go now and look at this is newly pending listings. Now, pending listings mean listings under contract. These are what you would call sales. They didn't close, but they're pending listings. In every single market, we have less pending sales than we had pre-pandemic because we have lower inventory. This literally, there's a one-for-one correlation. It's perfectly correlated. If you have less inventory, you're going to have less sales, right?
Right.
That is not the market's crappy. That's supply and demand. Okay, the supply curve has shifted, and the supply curve has shifted, and there's less supply. Okay, and it hasn't shifted to a point where price is falling, which you would think or would actually go up, and it has gone up. It's gone up in some markets, but demand has shifted too. Because remember, if you have less of a thing to offer people, you have less people that want to buy it. Because housing is not like it's generic, it's just a house. People are like, hey, I really want a house in this one subdivision because I always want to live there, and there's nothing, or there's one and it's not in my price range. It's too low, it's too high, it's not, it doesn't have the pool or whatever. So you're people literally sitting like on, realtor.com or Zillow every day looking in that one subdivision for like that one house to come on the market, right?
Well, sometimes people are sitting there and doing that.
Okay. On the next slide here, as you can see, here's Las Vegas. As you can see, we have far less sales than we have in a pre-pandemic market. So when you go, Todd, but sales are down 40%, that's really bad. It's not bad. It's because there's less stuff to pick from. We have pent-up demand, and this is an interesting thing that we've talked about. Think about this for a minute. All these people who have been wanting, 37 million people or whatever that told NerdWallet they were going to buy a house this year, they're saving money. Remember, they're accumulating cash. They're putting a little money every week away toward a down payment. And when they finally get a chance to get some inventory, there's going to be more people coming in with a bunch of money down to buy. This is not, just going to go away.
Right. And we see this, it's not just anecdotal, but we see this because when interest rates dropped a couple of weeks ago, all of a sudden they had tons of people wanting to lock in rates. There were lots of applications. So we see this. We see that demand, and it's harder to track when you're looking at homes under contract or homes that are listed. But it's easier to see when you're looking at lender applications, and those are really interesting numbers to look at.
It's going to take something interesting. And when I say interesting, something very different to happen. Okay, for real estate market to have a substantial downturn, it's to take some kind of black swan event, and I do not mean a recession. We all are pretty aware that in 4 of the last 6 recessions, home prices increased. The reason they increased is because prior to going to the recession, the Fed could see the economy slowing, and they started reducing rates, and then mortgage rates followed, and then more people could buy, and prices went up. And recessions, inarguably happen at different times of the year. But if it happens in the spring, home prices are going to go. If we were in a recession right now, which you never know, they could come back later and say we were in a recession during these months because we were supposed to have been in a recession. They said last year, first half of this year, we'd be in a recession. But home prices are going up.
Right. Home prices are going up. Inflation is doing better. So all those numbers that they track to evaluate the health of the economy actually look pretty good.
Yeah, economy is not as bad as people say. The people are saying, yeah, but there'll be job losses if we have a recession. Actually, I would venture to guess most of the job losses have happened. If we do have a recession, it will be a post-job loss recession where the companies say, hey, we got rid of the people early. We had all these layoffs to shrink the business because we expected demand to shrink. Demand shrinked in the future. We didn't grow like we thought we were going to grow. And then everyone will, exuberantly start hiring back up, even though they say we're still in a recession because people will say, hey, we can see we're coming. Remember, these numbers lag. We don't find out we're in a recession until after we've been in it for 6 months because you have to look back for 2 quarters of negative GDP growth.
Right. And, while arguably we live in a point in time when we have access to real-time data, The government is pretty archaic in the way it gathers data and looks at it and then compiles it. So that's part of the reason why there's this big disconnect between what all of us experience on a daily basis and the numbers that the government is putting out versus what the revised numbers then come out down the road going, oh, by the way, remember that time when you thought things weren't going so great? We were actually in a recession. But at the time, the government said that we weren't. So there's this whole archaic system that hopefully at some point will catch up with the rest of us. The interesting thing is that we're looking at a lot of this data, and we're tracking a lot of this data, and that's what we're bringing to you. Is we're bringing to you the most current data that we can get our hands on, so that you can be informed, entertained, and that you can make choices regarding your real estate life, and hopefully include us in that. Leave us comments and tell us what's going on with your real estate life.
Yeah, for sure. So anyway, bottom line is this. We have a shortage of homes for sale, which is the reason why we have less sales. You saw the year-over-year numbers. We're up 3% nationally in the U.S. A lot of markets are doing much better. 5 or 6 markets are doing not very well, but less than 10%. The predictions that we did in videos a year ago, we're talking that the worst markets would be down 20%. Never happened. The worst market wasn't even down 10%. People were saying 40 to 50% in Vegas, 3.9%, not even 4%. And prices are going back up already. So, will year over year, June to June be negative? Sure, it's going to be negative. But June of 2022 was a ridiculous anomaly. And, if you just chopped out like 3 months of 2022 completely and stuck it together, no one would be, talking about this at all. We would, or are likely still to continue to see inventory shortages, probably in the whole U.S. And one of the reasons is because we do not have foreclosures at all. They're not happening. I did see a video where somebody said the banks are just now starting to foreclose, right? But we know from the Fannie Mae data that it's not actually happening because the number of people that are 30, 60, 90 day late on their mortgage is the lowest ever. Mm-hmm. And all of those people who were behind on their mortgage during the pandemic, 2020, 2021, 96 to 97% of them have all been resolved. Mm-hmm. 96 to 97 per Fannie Mae. They either did a successful loan bond, they made up their payments, or any late payments that they had missed, they've fully made those up. And that's 2 years post modification.
Or the homes were sold. So remember, that's always an option for people who are behind on their payments. They can always sell the home. There are lots of home buyers out there, whether the house is put on the open market, like on the MLS, or whether it's sold to a private investor. Private investors are alive and well and strong, and they are marketing as best as they can figure how, anywhere between pay-per-clicks online, via mail. They're marketing to realtors about any off-market properties. They are out there and they are hunting for these properties, which means these properties are being sold. So they never end up as a foreclosure. And that's an important thing to remember, that when they don't end up as a foreclosure, that actually is good for everybody, right? Because now that homeowner gets some money in their pocket and gets to get on with their lives. Or, if they got caught up with their payments, great, they get to stay in their beautiful home. Whatever the situation is, it's a far better outcome than a foreclosure. And that's a lot of the reason why there are virtually no foreclosures.
Okay, 2 interesting stats, and then I'll let you close out the video. Okay, stat number 1.
Okay.
Over 85% of all homes have a less than 5% mortgage on them. Now remember, 40% have no mortgage. Mm-hmm. And then you have 70-something% that have under 5%. So you have over 85% of all homes have less than 5%. Those people have such a low payment, they're staying in their home because it's far more affordable to stay in that house than to go rent somewhere, okay? The second number is only 0.5%, which is 1 in every 200 homes, has negative equity, which means if you pick 200 homes and just randomly pick them, and I told you I'll give you $100 if you can guess which one is upside down. You'd never guess. It's 1 in 200. You have to be lucky to pick, right? Which means they are a little upside down, but everyone else has equity. So it's not like these people are going to say, "Oh, I'm upside down. I have to sell the house." You're never forced to sell, even if you have negative equity. And if you're one of those people who have negative equity, but you have this 4.5% or 3% or whatever interest rate, you don't really care about what your equity. Just because you took a HELOC out and then your home value on paper declined a bit, you don't care because your monthly service of the debt is so low. That's why we don't have foreclosures. We're not going to have foreclosures.
Right. The other thing to keep in mind is that you can do a workout with the bank as far as dealing with those payments if you're a little bit behind. But if you don't make your rent payment, you get evicted. So it's going to sound kind of bad, but you're actually better off having a mortgage. And if you get a little bit behind, you can catch up and not lose the roof over your head, versus if you get behind with rent, you're going to get evicted and you will lose the roof over your head. So that's just kind of something to keep in mind.
That's it.
Okay. So was it interesting? Was it entertaining? Did you learn something? Did you like the charts? I like charts. Please like the video, subscribe, hit the notification bell, share the video, leave us a note, tell us what's going on with you. Tell us what you think. Should we keep up the pace of doing almost one video every day? Or should we kind of back off a little bit and give you a break and do 3 or 4 videos a week? Let us know. We will keep going probably at 1 a day until we hit 1,000, and then we'll kind of listen to your input and decide how we're going to move forward from there. So we appreciate your input. We do read your comments. We look forward to them. Please be nice to one another in the comments, and we'll see you on the next video. Bye.
Bye.